Now, there are different people who do the break lines in different ways. So you can have your break line here, which would be perfectly fine. Or if you're more aggressive, you can have it. To be fair, hopefully you can see it doesn't make a difference. That will not make a difference. If that makes sense, right? Whether your long position was
Yeah,
here,
yeah. Materially, they're similar. They're very similar. Yep. Yeah.
have your break line here, just for the sake of recent chop. Just have your break line here.
Mm-hmm.
Now,
Mm-hmm.
also
Mm-hmm.
another thing. Let's go back to our framework here. Notice how we're between 10 and 10:30,
Yeah.
right? We did not trade between 9:30 and 10 because we're in a low volume area. We
Mm-hmm.
actually allowed the market to kind of digest because we're in a low volume area. Does that make sense? Does that make sense?
Yes. Yes, it does. Yes, it does. Yep.
So now from here we need to apply the bolt, and it's very, very, very important you apply the bolt. It even says only bolt entries. So we are going to really systematically break down what the bolt actually means. So break line, strength and clarity of breakout, body. Now I want it to be at least two candles. It doesn't have to be, but if it's two candles, it's just better. So I would give this a 5. Okay, are you following me there?
Yes. Yes, I am. Yep.
Okay, fantastic.
Yep.
Now, quality of pullback into the level. So to see a good pullback, you want to see at least two candles. Hopefully here you can see it's a lot more than two.
Mm-hmm. Mm-hmm.
So this is step 1. So step 1 is the break. Step 2 is the optimal retest. Step 3, what does the L stand for?
Um, oh, okay. Liquidity absorption. Okay.
Yeah. So we've done break line 5, optimal retest, at least two candles back into the zone. And do you remember what the rules about optimal retest were? Because I think we have been through this on a previous call.
I
What
think
was it?
that you said that. Yes, that at least half of the candle body has to enter the key level.
Say that again.
I thought the criteria was that at least half of the candle body on the retest has to be in the key level.
Okay, you got the half right, but not the candle right. So this is the key level between 95 and 90. The retracement has to be at
Mhm.
least 50% into the key level. It's nothing to do with the
Okay,
candle. It's
50%.
it's the key
Okay,
level.
oh, got it, got it.
So
Okay, got
actually,
it.
so here you can see pretty obviously that it's more than 50%.
Mm-hmm.
Now we're looking here at liquidity absorption. So liquidity absorption. What does liquidity absorption mean? This is the word you're referring to at the start of the call. Hopefully, this is where we
Yeah.
actually.
Yes. Yes. So I think what they're saying is that in a given auction, um, one side of the market has been completely exhausted at a given price level. I think that's what they mean by liquidity exhaustion.
Yeah, liquidity absorption is you're looking at the sell liquidity or the sell orders,
Mm-hmm.
and market struggles to really break below this zone, right? So when you see a liquidity absorption, it is basically a fancy way of saying what side of the market was unsuccessful, which is what you've said.
Mm-hmm.
Now here the sellers are pretty unsuccessful. In other words, the selling liquidity has been absorbed. The aggressive sellers have been unsuccessful at breaking price below this level.
Mm-hmm.
Yeah,
Mm-hmm.
we see that. So that's kind of step
Yes.
3 now.
Yeah.
That is going to be
Yeah.
step 3. And then,
Yeah.
so how would you rate the absorption here out of 10? Out of 20.
Um, I would say that
Sorry, out of
it
5.
definitely,
Out of 5. Liquidity
yeah,
absorption out of 5.
4 or 5. It's definitely very clear that at that lower bound, price is reverting. So I would call it a 5.
Yeah. Also, don't just get bogged down here. Look at this. Look at this. Look at
And that
these.
too.
Look at
Yeah.
this.
Yeah.
Look at
That's the
this. You
pattern.
know, yeah. Look
Yeah.
at that. Yeah.
Yeah.
So that's evidence of opposing orders being absorbed. So what we mean by opposing is if we want to go long, we want to see
Mm-hmm.
opposing orders being absorbed. So we want to see selling orders being absorbed, opposing orders for us to go long.
Mm-hmm.
Okay.
Mm-hmm.
So that's 5. And then precision for entry. So trigger. Now pulling the trigger is very important. I had a conversation with James about this. You are not allowed to go long until we get above this red line.
Mm-hmm. Mm-hmm.
So we're just waiting. Boom. That's where you'd go long,
Yeah.
and you'd have your
There
stop
we
below
go.
the zone, or
I
realistically,
see.
you can have it a little bit above if you want like that.
That makes sense.
And the trade itself wasn't a bad trade. I mean, I didn't capitalize from it, but bit of a nasty one to hold. But
Yeah,
it
yeah,
did fly. It did fly in the end, right?
yeah. It required a lot of patience. Yeah.
Well, let's see how much patience it took. This is not something. This is something out of our control. This is where you pull the trigger. So this is step 4.
Mm-hmm.
So what we've gone through here is we've waited for a break. We've allowed market to give us an optimal retest. We've then used footbridge charts to give us a liquidity absorption, and then using that information, we pull the trigger. 1, 2, 3, 4.
Yeah.
Okay, that is the Bolt breakout blueprint. Fantastic. Now, in terms of patience, you're completely right. 22, we didn't really get moving until 37. That's like a 15-minute window. Not ideal, but it's just one of those things.
Yeah.
Okay.
And I think you made a comment in the community last week saying that if a trade takes more than 15 minutes, that's probably a sign that you should just get out.
Yeah. Get out at small win or small loss, whatever it is.
Yeah.
Now, so does that make sense? So what we've done on Thursday is we've basically gone through the entire Bolt breakout blueprint. Now that trade was situated between 10 and I can't remember what time the trade hit its target. I genuinely cannot remember. 10:45. Okay, yeah, that's fine. So there you go. So we've now, so that was 20 at the start of the call. We've understood at the start of the session. Then we had 20 in terms of understanding footprint charts. Then we had trap framework, which you identified trap sellers correctly before you bought. That's 20. Then you follow the Bolt breakup blueprint. That's also 20. So you've gone through. That's basically 80 out of 20. Sorry, 80 out of 80. That's a very good execution.
Yeah. Yes, I agree. And I see that you have the score guide as well to kind of tell you the whole quality of the setup.
Yeah. Yep, perfect. Now, following our following our rules, that trade came at 22 past. Can take trades. So we're in the area of low volume. We used a Bolt entry. Yes. Best trades between 10:15 and 10:30. That trade was at 10:22. So perfect. When we say out of trades by 10:30, we want to be managing them. So let's say if at 10:30 we're still stuck at our entry, or we've had barely any moves by 10:30, it's probably best if you exit. Yeah.
Yes, I agree.
Perfect.
Yes.
Now going into 10:30 to 11, so the last half hour. This is now chunk 3, or technically chunk 4 of the session if you include the pre-market plan. Very important you take profits, especially in choppy market conditions or low volume conditions. Take profits. No trade. If you still haven't taken a trade between 10 and 10:30, it often means you're inside of a chop and you want to be very mindful. And if you can clearly see a range for more than 40 minutes at the same level, especially, you have to walk away. Therefore, by 11 a.m., you've either taken a winning trade or you've walked away from potential losing trades due to a chop.
Yeah. That makes a lot of sense. Yes, sir.
Now, I'm going to keep this up. And what we're going to do is we're now going to use this for Friday, because on Friday it was slightly different. Not the rules, but how the flowchart played out. So what you can see here is the trade was a little bit delayed on Thursday due to the volume profile. You see that?
Yeah.
But on Friday, the move happened a lot quicker in the session. You see that? It actually happened at 9. I was done by 9:45. I was done before 10. You see that? Now, the reason why is because that trade happened at what we call, do you know what this yellow line represents?
The yellow line, I don't know.
It stands for POC, which stands for point of control. Now, you don't want to get you don't want to get too bogged down by what POC. Why is it called POC? Basically, POC, the yellow line means the maximum amount of volume on the profile for the previous day. You see that?
Yes.
So when you're in the blue region, it's generally good, but when you're at the POC, it's like the highest amount of volume. So it's an optimal area to trade, and you're going to get the most amount of follow through, the most amount of, I guess, quick moves, because the market has high volume there, meaning it's actually interested in trading at this area. because this is the POC. This is where the maximum amount of volume happened. But volume equates to interest. Yeah, interest.
Yes.
Volume equates
Yes.
to interest. Now, low volume equates to a lack of interest. High volume corresponds to interest, so you're more likely to get quicker moves from there. Now,
That makes sense.
in low volume areas, you can still trade them. You just have to be a bit more cautious, which is why we have the SOP checklist here. So let's go to Friday now. So
Mhm.
4-step positioning process. Now, it's important to understand levels that have held from previous days. You do not ignore them. That's something that
Mhm.
I make very clear. So I made a post about this. So what